We are joined now by a veteran observer of the mining scene, John Kaiser of Kaiser Online. Of course, he has been, well, focusing on the emerging explorers, the emerging producers for, I don't know, how many years have you been doing it, John?
1983, when Hemlo was discovered.
Oh my gosh, that goes back. You have been watching in recent years the decline of the junior miners. You reckon that the junior sector is in its 9th year of downward movement, a 9th bear market, or 9th year of a bear market.
Yes, and it's getting critical. There is no money going, little money going into companies. Half of the 1,200 venture listings that are in the resource sector have negative money. They owe about $2 billion. The other, about sort of 40%, they still have $2.5 billion in the treasury. But the pathways of money coming into the companies, it's being strangled by boomers. Every boomer is now 55 or older, so gambling on these juniors is unsuitable. And the post-boomers, people born after 1964, they don't know anything about this space, and they're not accredited investors, so they can't put money into private placements. Maybe a few of them are accredited, but most of them, the money can't go in. The system is being starved to death for capital to allow this ecosystem to thrive.
It seems like this has been going on for years. Are there any chinks of light when it comes to the juniors?
They did introduce the existing shareholder exemption, which limits you to $15,000 per company per calendar year, and you don't have to be a millionaire or have 200 grand of income. And that's, I think, a very, very good step. But they say you have to own shares in the company when the company announces it, and if you don't, you can't participate. They need to get rid of that provision so that when some company wants to do a financing at 5 cents and they make it available for this exemption, people can do their homework, go there, call up the company, send them their $5,000. We need to broaden the base of money coming in because the brokerage industry is changing. It's now fee managed and it's focused on the bigger cap companies. So all these little juniors, which are the source of fantastic discoveries in that, they are either, the money's being channeled through them by like cartels, groups that are catering only to a small segment of the population. The diversity of the system is being crushed.
Now, we heard earlier from Mark Bristow, who's the boss of Barrick Gold, and he says for even the big companies, there's been a dearth of new discoveries. Let's have a listen to what he told us. Let's run that clip.
The big problem is this whole wrestling with the mining industry, its relevance and its importance in the future, and of course balancing that against ESG. And most importantly today, my message is, to create value in the mining industry, you really have to invest in geologists and exploration because we're running out of runway in our industry because we haven't invested in exploration, and whether it's copper or gold or any of the base metals, we're struggling with the reserve profile looking ahead.
So your take is that the junior sector is sick, and of course they were crucial incubators for projects, and traditionally the big companies would come in and buy the junior or buy the project.
Yes, and the old day of the prospector going there and traversing the landscape and finding stuff sticking out of the ground, that's pretty much done. So now we have a situation where the majors are either doing brownfields exploration within their existing operations, or they acquire a junior that has found something from scratch. And we are into a new age of way more technology, digital technology, the 3D visualizer, what's going on under the ground and all the multi-data sets putting together, and the younger generation is very much attuned to that. So there's a window here for younger geologists and that to come into the system. But this is why the juniors are so important, because they do the risky stuff, but without money to pay this younger generation of geologists, those people don't have jobs. But I also think we need to teach these post-boomers, people born after 1964, how to make money from this space. Why can a stock go up 10, maybe even 100-fold as a result of an exploration discovery? And broadening that audience will also intrigue the ones who like rocks, who want to do this exploration. I think the setting is there for this to happen, but the juniors are really critical to making it a reality.
I suppose the paradox here is the industry does have a bad reputation for over-promotion, but we've seen this huge tightening of regulations, but in some ways that's strangled the industry as well, so there's kind of two competing forces there.
Yeah, well, one of the problems is, I mean, let's be frank, it's gambling. You're gambling on an uncertain outcome, hoping for 5, 10, and as I mentioned, 100-fold outcome. But what is the size of the prize that the company is chasing? If they're successful, if I buy the stock at 5 cents, how much would I make? And 43-101 rules say the company can't say anything until they publish a resource estimate and then a PEA, an economic study, which puts all those numbers in there and say, okay, but by then the market's already priced in what the valuation is implied.
The pros have kind of moved in by then.
Well, it gets leaked out and everybody has a rough understanding of where it's going. But what we need is the public to be able, the crowd, to generate their own visualization based on all these disclosures that the regulators force the companies to do. I mean, 43-101 has been great in forcing all this disclosure, all this detail to be made public so that a huge audience can look at it, parse it, and come up with their idea of, let's say you have another gold rush deposit, 10 million ounces in Nevada. If you found another one of those, what would it be worth? Well, you can do the numbers on that and say 2 billion. Then you look at the company that has such a project, how's the market pricing it? And one of the key things I've been working on is the idea of an uncertainty ladder. Just because you have a little dot on the map that could be another gold rush doesn't mean your stock should be at 2 billion. It should be at 0.5 to 1% of billion. So there is a rational basis for assigning a fair speculative price to an exploration play, and most people don't understand how that works.
John, very quickly, we've only 30 seconds. Give us one name you're watching right now, please.
Well, the one that I've been watching, it's not in the gold sector, it's FPX nickel, and it's an example of where you could make many times your money. It's in the nickel space, it's a different style of deposit, but you know, I've talked about the investing for greed, making a lot of money, but also investing for good, impact investing. If you want to pull in younger people, show them where you could make a lot of money. If the PEA shows this is real, it goes up substantially.
Where is the deposit,
It's in central British Columbia.
Okay.
It'll be a 40-year mine life. It might even be carbon neutral when it's done because of the peculiar nature of the magnesium in the tailings. So showing the post-boomers these types of combinations where they can make a lot of money in this space, but also indirectly contribute to a greater good that lasts way beyond the lifespan of us boomers. I think that's the key to get them in there. Plus, allowing them to be influencers, which is in this shaping of the visualization, sharing them in a public space, and allowing it to happen.